Are you looking to purchase real estate in 2024? Well, in this video, we're going to outline a handful of factors which will help you determine what the best place is to purchase your next investment property. Hey guys, Ehren and Josh here for another episode on the Finance Fridays. Today we're going to talk about best places to invest in 2024. Now, as markets change, locations in which people invest also change. And we have some predictions in regards to where we think most investors are going to start looking at or continue to look at when investing and executing on the strategies in 2024. Now, needless to say, 2022 and 2023, if you put money into real estate, you made money. At least for the start of 2023. There wasn't really anywhere you could go wrong. Appreciation was significant across the board for all locations. And to echo that, lending was also a whole lot easier in all locations if everything was going up. Location is probably the most important thing you can choose when being a real estate investor, because it will affect the type of capital and the type of financing you're going to be able to achieve when executing on your investment strategy. A lot of people don't know this. They'll just think, oh, well, I'm buying in this location. Maybe it's remote up north. Maybe it is in a tough area down in Sarnia, down south. Or maybe it's in a very specific area that lenders don't lend in Hamilton. A lot of people think it's just like, oh, well, it's a place, I can buy it, 80% down, no problem. And that's not necessarily the case. And when credit starts to crunch and things start to get tighter and values start to decrease, lending doesn't necessarily like to go in certain locations. So we're going to discuss today what locations we think are going to be great to invest in and what locations maybe you should stay away from.
If you're looking for your best pricing and your best financing and loan to value options, major city centers are going to be your best options. Right now, with the way that the housing economy was the last year and a bit, prices falling, values falling, lenders don't want to get aggressive with their loan to value and interest rates in some of these secondary markets. Places like Chatham, even Windsor can be tough. Timmins, anything that's outside of the range of these 100,000, 50,000 population areas, you're going to get less favorable pricing. So if you're an investor and you're looking to get your best bang for buck in terms of the amount of capital that you have to bring to a deal, sticking to these major city centers might be your best option, in terms of just keeping it at 20% down. Now, I'm sure you could go a little bit further and kind of start to overanalyze, the price cost comparison versus a major city center versus, a secondary or tertiary market. But again, trying to figure out how much you're gonna have to bring to the table in that loan to value, plus the additional cost on that interest rate. Your best areas to invest are going to be these major city centers.
Without a doubt. And when we're looking at locations, essentially in Ontario, there's this three. It's like GTA. There's outside of GTA, like Golden Horseshoe and major urban markets, like go at Hamilton, Kitchener, Waterloo. You got Oshawa, that whole corridor outside of the GTA. Really great to invest in. People are still looking for opportunities there. And then you have secondary markets, like 15, 20 minutes outside. Lenders are still looking at that as well if it's a commutable distance to a major urban center. But outside of that, you're limited to your options. So if you guys haven't tried to purchase a property or refinance a property with private debt or semi B debt, loan to values have reduced this year. 80% in secondary markets isn't necessarily a thing anymore. Most private lenders don't offer it, and if they do, it's very expensive to be able to take on that debt. So when you're looking to acquire a property in outside fringe market and you're expecting 80% loan to value and you're looking for a private or alternative option with a B lender, you might not necessarily be able to meet that debt servicing or that loan to value that you really need. So keep that in mind. Now when you're looking at opportunities to purchase and make the numbers work, not only is it cost per unit you should look at, but also carrying cost on debt. The GTA is really tough to make any numbers work. People who were purchasing the GTA last year or 2 years ago who had a condo, for example, that cost of debt on the condo, you were kind of able to break even. Maybe you were slightly negative, but not crazy. That's not the case anymore. Capital is expensive and numbers don't work. So most investors are definitely moving outside of the GTA and sometimes even the Golden Horseshoe area. And the opportunities that we're seeing are, on the fringes of the GTA. So St. Catharines, Hamilton is still a great opportunity. It's commutable. Burlington, if you have enough capital. Kitchener-Waterloo, Cambridge, Barrie still, depending on, what your price point is. Those markets, from a cost per unit perspective, as well as, a carrying cost perspective, are going to be great opportunities for an investor to take a look at as they're moving into 2024.
Yeah, I think, something else you got to kind of keep in mind too is if you're looking at doing any sort of, like value add type project, your end, profit is really going to be driven by your appraisal. And if you're looking at, city places that don't have a whole lot of transactions going on, you're not going to have the data available to really support that increase in value. So, that's kind of a big piece of it that you really have to consider is not only what are you buying at and what is your structuring going to be available from the lender, but how much data is available and how much, what are the volumes of transactions that have happened in the last year to really support that increase in value. It's all fine and dandy if you put it together and you get the package and your property probably should have some sort of 20 to 30% increase after the renovations. But again, if those previous sales aren't there to support, you're not going to get that value no matter how great of a package and how hard you push on the appraiser. Yeah,
and in a market that is decreasing in value, it can be really challenging to find comps that are going to support the ARV value that you're looking to take on. So great point. I can't tell you how many times I've got an argument with an appraiser about what it should be versus what the actual comps in the area. Because if you're looking at comps, most banks right now are looking at 30, 60 days. Anything past that, a declining market isn't necessarily viable for a bank to be able to determine value. And if you're purchasing residential real estate, the majority of the weight of an appraisal is based off of a direct comparison of the asset itself. So it can be decently challenging to get that value too if you're in a small market. Definitely agree. Something else to keep in mind is the municipality. So densification is becoming a real thing, and different municipalities are getting through the Bill 23 and they are looking at increasing density. And so if you're looking at taking a crack at a property this year or in 2024, increased densification is going to be really important, not only for your purchase price, but also your ARV value, because if you have the ability to be able to increase the amount of rental revenue that's being produced on a property, that's going to allow you to be able to debt service in a high interest rate environment. So there are some municipalities that are more conservative with it and some that are more liberal with it. So you have if you are going to be looking to purchase, definitely take into consideration what municipality is more favorable with allowing you to increase density. For the retail investors, somebody who's looking to maybe not get into like a true commercial property, this might be a great way to be able to purchase a property and still force appreciate while being able to debt service in a decent market next year.
Yeah, and you can even take the the geographical area conversation a step further, taking a look at CMHC multifamily and their energy efficiency program. One of the things that they look at in the scoring of the points is what is the source of energy and how cheap is it to get that energy. If you're taking a look at areas like Hamilton versus areas that are more remote and not near any sort of like natural hydro dams or gas lines, it's going to be more expensive to get certain types of energy resources in certain areas. When you're taking a look at repositioning and getting these points, sometimes it's a lot easier to get these points in these specific target markets versus these more remote areas. So there's so many different reasons why you should really be picking certain areas to invest in versus other areas, taking a look at the programs that are available, any sort of rebate, stuff like that, density changings. Not every region and municipality falls in line with these 10 units and unders with the Bill C-23. So just making sure you have an understanding of where you're investing and what programs are going to be available.
Just echoing what Ehren said, if you are moving into the commercial space next year, there are a handful of lenders out there that are HSA approved. That means essentially your exit strategy allows you to move into CMHC. Not all financial institutions, especially the alternative ones who allow you to purchase a property that does have under one debt servicing, they don't go to every market. So if you are going to be looking at secondary markets or tertiary markets that have great deals, that's phenomenal. But understand that the new rules with CMHC and the type of capital that you're going to be able to take on are going to be limited. So it's going to extend your ability to be able to execute on your strategy if refinancing into CMHC really is what your end goal is. So keep in mind that, Timmins, Ontario, and the remote areas of Ontario, banks don't necessarily have an appetite for those places right now, so you may be forced to close with more private capital, which could either be more expensive or could limit your ability to be able to take out the financing when your project is complete.
Continuing the multifamily trend, another reason why you want to take a look at different regions and do the comparison is taking a look at MLI Select and their affordability. If you want to compare like a major city in Ontario versus Edmonton, Alberta, the ability to get a successful project repositioned and still cash flow doing just the affordability only, drastically more successful in Edmonton than it is in, say, London and Kitchener, Waterloo, Guelph, GTA area. Taking a look at Edmonton, your median renter income in that 30% mark is $1,660, where the average market rent in that area is about like $1,100 to $1,200. So you still have about $400 to $500 in increasable rent versus taking a look at these cities in Ontario. You can hardly make any affordability projects work in a major city center in Ontario. So, again, taking a look at the programs that are available and what type of asset are you looking to get into and how you're going to qualify. For multifamily guys, a lot of the success coming from the Alberta market compared to the affordability in Ontario.
Yeah, a lot like animals migrating. Investors seem to migrate as market conditions change, and we have seen a ton of success out that way just due to the affordability guidelines with some new products that came out last year. We're not dissuading you guys from purchasing real estate in secondary markets. Our job is to let you guys know what the current market is doing in regards to the type of capital and how they're deploying it. So, if you do have a project, and there are great projects out, up north, down south, different places, just let us know. There are some alternative financing options we can help you with. Guys, we really appreciate you watching this video today. If you did like this video, please hit the subscribe button, hit the like button. It allows us to make more content like this for you every single week. We really do appreciate everybody watching. If you have any questions, please reach out to Ehren and myself. You can reach out to us either on Instagram or directly. Our contact information is down below. Until next time, appreciate it.